All right, so now that we've talked about percentages, we're going to talk about ways to apply that to your personal income or your personal finances. The first thing is your income tax. Okay, real basic. It applies to everybody, right? I've heard it said there are two things guaranteed in life: death and taxes. I don't know. I'm sure there's other things, but you got to pay taxes, and taxes are just the government's way of making money so they can spend it. Now that sounds kind of weird, but it is necessary, right? I mean, our government couldn't function without a revenue source, without a way of making money so that it has money to spend on things. And we are the source of money, the citizens of that country or the state or whatever, the city, wherever you're paying the income or wherever you're paying the taxes to. The citizens are the source of that revenue. And so the federal government taxes our income. In other words, they take a percentage of what we make each year and use it for their own purposes, right? And that's where our schools get funding, our roads get fixed, all those sorts of things, our military budget and all these different things. Some are good, some are bad, but doesn't really matter. We got to pay for them. So, so that's basically what we're going to summarize here is your income tax. How does the federal government determine how much money to take from you in particular? Okay, and so there's some really important definitions here, some categories that I need to get straight so that you can calculate these things. And the definitions are harder than the math, right? The math is just simple subtraction and percent calculations. It's not super complicated, but knowing where to put things is really important, okay? So when you're figuring out your income tax, everybody's taxable income is different based upon certain conditions. First of all, what you make is very important. That's the base, that's the foundation. So I have that listed first. That's called your gross income. Okay, gross income, that's your earnings. This includes things like your wages, if you're, wherever you work, your salary, whatever you make, whether it's an hourly wage or a yearly salary or whatever it is, that's included here. The tips, if you're, a restaurant wait staff or you're working, I don't know, parking cars for a VIP, restaurant or something, you get tips, right? Tips come in a lot of different forms. So wages, tips, interest. If you have money invested in savings accounts, the interest you earn, which is usually somewhat minimal, unfortunately, is included here. Dividends. This is if you have money invested in stocks, for instance, then what you make from stocks are the dividends paid to you by that company. Business profits, if you own your own business and you make profits and you keep those for personal use, those get included here. Rental income, my wife and I had a rental home we owned a home that we were renting out for a couple of years quite some time ago, and our rental income was part of our gross income. And there's other things in here as well. But that's just a short list of some of the more common ones. Okay, when you add all that stuff together, again, just math, right? You're just adding these amounts together. That gives you your that gives you your gross income. Now, there are things called adjustments, and adjustments are things that you take off the top. If you put money into retirement funds, certain retirement funds, some of them are tax deferred, which means that you take them off here. Some of them are not tax deferred. If they're not a tax deferred retirement account, then you don't worry about it. It doesn't get factored in until later on. Or it gets factored in actually when you make the investment, when you make the income. So that's all different. But certain retirement contributions get taken off here. Medical savings plans. Where I work, we have something called a flex spending plan. I can set some money aside pre-tax, called pre-tax, so it's not part of my taxable income. You set some money aside to be used specifically for medical expenses, and you have a certain amount per year that you that's a maximum. You can't go over like $2,000 something. And you don't have to put all that away, because the risk involved in that is if you put more in that account than what you actually need, then you end up losing it. And there's some technicalities there, but the perk is you don't have to pay taxes on it. So you put money in that medical savings plan, or what we call a flex spending plan. That can take place under the adjustment. So all those amounts just get taken off the top. They don't get taxed. Okay. After you take those adjustments off, you have something called the adjusted gross income. You know, the gross income, that's the original amount minus these adjustments. Okay, and that's kind of like where the actual tax values start, is your adjusted gross income. Most people say, you know, I make, you know, $100,000 a year. That's usually your adjusted gross income that you're referring to. You never really see these retirement contributions, your medical savings stuff. A lot of times, those are actually taken right out of your paychecks, and so they never actually get to you. Okay, that's usually what your adjustments are. There are things that are taken out of your paychecks usually before you even get them. Okay, so that's your adjusted gross income. The exemptions and deductions come off after that. Okay, so this is money you actually see. You know, it gets paid to you typically, and then you do something with it. For instance, well, now an exemption is a little different. So an exemption is a fixed amount for each dependent. So you get this money, and then depending upon the number of dependents in your home, that's you, your spouse, your kids, so the number of dependents determines on the amount here. So it's the same amount per person. I don't know what it is currently. Our textbook says something about it's I don't know. In the year 2016, it was $4,050 per person. I don't know what I'm sure it's changed since then. But it's a set amount per person. So in my household, I have myself, my wife, and our 3 kids. So it's 5. We get 5 deductions. Okay, or 5 exemptions. And that's just at $4,050 or whatever the amount is currently times 5. Okay. And then you get your deductions. So you get your exemptions, that's just for your dependents. Then you get your deductions, and the deductions are taken off in one of 2 ways, and you have to choose this. There's something called the standard deduction, which is a fixed amount that's available for everyone. Okay, it doesn't matter how much you earn, or how many dependents you have, or how much you give in donations. It doesn't matter. This is an amount that's available to everybody if you choose it. You don't have to. You could choose a different option, which is your itemized deductions. And if you choose itemized, you're hoping that your itemized deductions surpass the standard. You typically want to take the bigger of the 2. Your itemized deductions are different for everyone, and they're dependent upon this category of things. Things like your charitable contributions. So if you're giving money to a church, or you're giving money to a hospital or some nonprofit organization, that stuff, charitable contributions, that will come off here under the itemized deductions. Mortgage interest. So when you own a home, the loan that you take out to purchase a home is called your mortgage. And the interest that you pay on that mortgage loan is deductible here. So if you're paying, if you pay $10,000 in a year just on interest on your mortgage, that's not the principal, that's not paying off your mortgage, that's the interest itself. That's deductible. So you can subtract that here. And your property taxes. If you own a home, you have to pay property taxes to your local government. That stuff is also deductible here. And there's a variety of things that are deductible in this category. When you get those together, add them all up. If that surpasses the standard deduction, then that's the one you really want to choose. Okay, so anyway, so once you get that all figured out, you figured out which of the 2 deductions you want, itemized versus standard, whichever one is the larger, and then you get your exemptions. That's the number of people in your household, the number of dependents, I should say. times the amount per dependent. Then you take those two amounts away from your adjusted gross income. Okay, so your adjusted gross income minus the sum of those two, the exemptions and the deductions, will give you what's called the taxable income. When you figure out the taxable income, that's the amount, or that's the value, yeah, the amount that the government taxes. And so then they apply a percentage to that amount. Now what's interesting is that's a variable percentage. The percentage is not fixed for everybody. It changes based upon that amount. So people in what we call tax brackets will be taxed differently. So if your taxable income fits within a certain range, you get maybe 15%, or if it's in a different range, it's 30%, or if it's a different range. So every different range of taxable income gets a different percent that is applied to it, okay, to determine your tax, the amount that you pay in taxes, all right? Now this is all for the federal government. Keep in mind, however, that state governments and some city governments also charge taxes on your income. With some exceptions. There's a list of exceptions. Your textbook has it here. There are some states that actually don't charge income taxes. So those are, what are they? Florida, South Dakota. Where did the list go? I was just looking at it too. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. So if you don't want to pay any sort of income taxes, that's where you want to live, right? However, you know, they make up for it in other ways. Maybe their sales taxes are higher, or their property taxes are higher. So they've got to make their money somehow. You know, or they have smaller governments and they don't spend as much, right? So those are the options. But anyway, so this is just your basic, your basic starting block for calculating your income taxes. Now, of course, you have to have all this information straight. You've got to know what's what, and you've got to know all these amounts, right? So keeping good, accurate, detailed records is very, very important. What my wife and I do, she does better than I do, is we keep all this stuff in a file in our filing cabinet. We have a taxes for 2021, say, file, and then we just, every time we get something, some of this information, we put it right in there. You know, our receipts from our charitable giving, for instance, go right in that file. You know, our stuff for our flex spending, right in that file, right? All these amounts are our interest at the end of the year. We get our interest statement for our bank, you know, go right in that file. Our W-2s, W-2s are the report from your employer on your wages and tips. That goes right in that file. Everything goes in that file as soon as we get it, and then when we have our taxes done, we take that file out and everything's right there. Okay, so you're not digging through last minute trying to find stuff and then you lose stuff or forget stuff. It's good to be very, very organized, okay, for tax purposes. This is not my strong suit. I mean, it can be, but my wife generally takes care of a lot of that stuff, so I give her credit for that. But I do know that it is very important, and when I do get some of that stuff, it goes right into that file. So make sure that, you know, you keep yourself organized and just kind of know where this stuff is. Now, when we were younger, when our taxes were more simple, when it was really just our wages and tips, a little bit of interest, and, you know, maybe a charitable contribution here or there. You know, we lived in an apartment, and, you know, we didn't have a mortgage and property taxes and all that stuff. When it was very simple, we did our own taxes on the computer and sent them in. As life has gotten more complicated, we have 5 dependents, you know, well, there's 5 dependents in our house, and at times that changes because we do foster care too, but currently there's 5 dependents. We've got, well, we don't have a mortgage right now, which is nice, but you got your property taxes, and you've got your retirement, and you've got your medical savings, and, well, when we had a rental house, you know, all this stuff makes things complicated. And you can still do this on your own. There's no reason you can't. We now have decided to pay someone to do this for us, but it's important still to know what's what. They're going to ask you, you know, if you take this stuff into a CPA, which is a person trained in tax laws and knows what they're doing. You know, you take all your stuff in. You know, you still have to know what's what. If they ask you questions, what's your income? What's da da da? Do you have your, you know, do you have any rental income? Do you have this? It's good to be prepared to know what's, you know, what's involved, and then when they send you a copy of your prepared taxes, you double check it and make sure they didn't make mistakes, because they can make mistakes. Okay, so it's still important, even whether you're hiring someone to do this for you or you're doing it on your own, to know how to do this, because it can save you a lot of money. It can save you a lot of hassle, because if something is filled out incorrectly and the IRS audits you, that is quite a pain in the butt. I have not had that happen yet, but I've heard that it's bad. So so you save yourself a lot of hassle by learning how to do this, and then in the next few videos we'll go through some examples.